Back to the top story of the day, the Fed raising rates to the highest level since the pandemic. Stocks rallying on this historic move. But our next guest warns the Fed has a way to go because inflation has metastasized. Richard Fisher served as Dallas Fed president and is a CNBC contributor. Richard, great to have you with us.
Thank you, Melissa.
So obviously this is...
I love the panel, by the way. You guys are tough. I mean, weed whacker, sledgehammer,
bulldozer.
Bulldozer. Well, you're tough.
What do you think is the appropriate characterization of what the Fed is doing, considering a lot of the inflationary pressures that we're seeing across the economy is completely out of the Fed's control?
Well, I'm not sure it's completely out of the Fed's control. I do disagree as much as I admire Chairman Powell. The idea we don't have a wage price spiral. Talk to any CFO, any CEO of any business, public, private, small, medium, or large, and they will tell you that they have trouble finding labor and they have to pay up for it. And once they get it, their productivity is lagging and they have to work on it over time. So I do think we do have a wage price spiral, but what is required here, as you mentioned, I do believe that this cancer of inflation has metastasized in our economy. It's going to take very harsh, but also precise surgery. I think Powell was very frank, and I like his honesty in the way some of you call it uncertainty, but the fact that he has basically said, look, we're just going to have to watch this carefully. They're admitting their decision model, which is what I call the horse out of the barn model. That is, you wait to see if inflation's actually there and then you act. It takes 18 months to work its way through the economy, the real economy. Markets react instantaneously. Businesses cannot do that. They have to figure out everything from lagging their payables, accelerating their receivables, all the way up through CapEx, HR policy, the works. And every company I talk to, and I listen to every earnings report that I can get my hands on or my ear on, are saying they're going to take more pricing. And they're going to project this as long as they can to protect their margins. Look at the NFIB survey that came out yesterday. More companies are talking about taking aggressive pricing. These are not listed companies, they're private companies. They employ half the people in this country that are workers. They create 80% of the jobs historically. They're all saying, going back 48 years of history, they're going to take more aggressive pricing action to protect their margins. So this is going to be a longer term process. I wonder if 4% is going to be the top, because I think this is running longer, deeper, and the Fed has a role to play, although he's right, that is, Powell is right. Thanks to Russia, Ukraine, COVID lockdowns and other things, not everything's under their control. But what is under their control, they should act on, and they're going to have to act. And I think it's going to be harsh medicine, radical surgery.
Mr. Fisher, I admire... Oh, I'm sorry.
No, please, go ahead.
No, I was going to say I apologize. There's a bit of a delay. I just want to say, first of all, I admire you a great deal, your candor and your intellect, for sure. This is a statement and a question. I think the wealth gap in this country that is undeniable, and it's in large part due to Fed policy over the last few decades. That chasm continues to grow, and inflation really only hurts the lower and the middle class. You know, the upper class can sort of laugh about what they're paying for gas. It really doesn't matter. That's my statement. My question is sort of this. I'm wrong all the time. If you watch Fast Money for the last 15 and a half years, you know I'm wrong a lot. So I have no problem with being wrong. My problem is the hubris associated with somehow thinking the inflation that they begged for years, they could somehow control once they got it. Because that, to me, is the height of hubris.
Well, as I mentioned, it's a horse out of the barn approach. They adopted it at Jackson Hole in the summer conference a little over 2 years ago. I criticized it then. I think it's a mistake, because you wait to see whether or not inflation is transitory or not. You want to see the whites of the eyes of inflation, and then you act. Now, we made mistakes in the past. I served under Alan Greenspan and under Ben Bernanke and under Janet Yellen. And we made mistakes in the past by projecting improperly. We sometimes got it right, sometimes we got it wrong, but we took preemptive measures. This is post measures, and therefore it takes longer. So perhaps you and I are on the same wavelength here. It's going to be a very difficult thing to do. It hurts those dependent on fixed income, as we all know, and the lower income groups. Although in terms of some of the very rich that has been made recently. Remember, there are over 1,500 companies that have gone public in the last year that had nothing. And zero cost money allowed them to be financed. And I am worried, by the way, by credit. We're going to see some serious failures here and some serious corrections and some real stress. It's an opportunity for good investors like you guys, but it's going to create some real turbulence and volatility in the market and maybe a serious situation that someone's going to have to cure either through monetary policy, regulatory policy, whatever it may be.
Are we talking about a systemic issue, Richard?
I don't know if it's systemic, but I know this much. When money is free, you discount the present value of future cash flows mathematically to infinity. Mm-hmm. So look at what happened in the crypto space, in the fintech space, in the meme space, M-E-M-E, I don't even know how to pronounce it anymore. But a lot of retail investors here, young people that just thought money was free forever, particularly those retail investors, I think are going to be seriously hurt. And that'll be interesting to see if it creates a major incident and whether or not the Fed needs to react or someone else needs to react to cure it. I think there's some black swans out there. That's my point.
All right. Richard, it's always great to get your thoughts. Thank you so much for joining us tonight.
Well, I love the show, Melissa. I think you have a great panel. And all I can say after this is have a great day.
Thank you. I got the best panel in the business, that's for sure. Richard, thanks. Good to see you.
Thanks.
Richard Fisher. Karen, would you agree that there, in terms of black swans, credit may be an issue, especially, I mean, it is true. We have a whole cadre of companies that came up during a no cost of capital period. They borrowed up the wazoo, they went whatever it is, and now look what's happening to rates so quickly, too.
Right. So what's happening to rates and also what's happening to valuations, of course, because as rates go up and you discount infinity to a lot closer, you get a lot lower value for sure. But I think that easy money's gone. We're going to, the SPAC thing is blown up. And so I think we're going to see a lot more of that reckoning. But also we had a lot of companies that took on debt post-pandemic that are now having higher costs. We talked about this yesterday with airlines. I don't know if you watched the show, Melissa, when you were not on, but we talked about that and how the cost of capital will eat its way through a lot of companies. But I feel like that'll create some interesting opportunities. I'm short high yield, have been for a while.
I'm deep in a 5 o'clock feeding during the show, so no, I didn't watch. But Grasso, what do you think about in terms of black swans? I mean, you're the one who thinks the worst is to come for the economy.
Yeah, I mean, trying to guess a black swan is probably a pointless endeavor. But if you're looking at a rising rate environment, you probably can have a Super Bowl market to everything that Richard said and to everything we know on this desk. You're going to have, Karen pointed out, the end of the SPAC markets. You're going to have less IPOs, less deals. You probably could have more M&A, people bottom fishing, trying to pick companies that they think could be accretive. But you're not going to see a bull run. If you're not going to see a bull run, then you're going to see equity classes go away, and that could be, or just lose their luster down the food chain. So as far as a black swan event, it doesn't have to be a black swan event. This just could be a deterioration of the market down to, Tim said a couple of levels earlier. I pointed out that Feb 2020 level of 33.50. Maybe we go lower because we're in a rising rate environment. And I think that takes the gusto out of all investors, whether you're retail or institutions that have been lulled to sleep thinking that these profits are forever. The day the market bottom is in is when people sell their Apple, not when people sell their Zoom.
Hasn't that been happening? I mean, just quickly, because we're out of time here in this segment, Guy, but we haven't talked about trading what is going on right now in response to the Fed. We talked about a short-term rally. What do you trade in a short-term rally? What we saw today, the sharpest gains in the NASDAQ 100 and the stuff that got bombed out. And it was interesting to watch Apple basically do nothing as large-cap tech moved higher earlier in the day, and then finally it caught a bid after the Fed decision.
Yeah, I think Steve makes a good point about the generals sort of the last to go down, and Apple's clearly one of those generals. And look, it's very hard to be tactical in this environment. I get it. Tim talks about that all the time, and we try to do our best to help people navigate that. I think there's an opportunity here to be tactical in the form of some of these higher flying tech names for the next week or so, where I think you're going to see a pretty violent rally. I think what's going to wind up happening, and we're going to have this conversation quickly with Paul Sankey, I think energy will sort of fall by the wayside, which will then theoretically be your opportunity to get back in there. I know that's a lot, but that's how I'd be looking at the next week and a half, 2 weeks.